Active managers in Australia struggle to beat the Australian stock market. According to S&P Global, over the past 15 years, just 15% of managers have consistently beat the ASX 200 index. So, we went hunting for an Australian fund manager who consistently beats the Australian market.
They only take the best of the best.
The best investment by far is anything that develops yourself.
Welcome to the Best of the Best series on Equity Mates, brought to you by Viola Private Wealth. Over 6 episodes, we're speaking to some of Australia's best investors to understand how they approach markets and what we can learn from their processes. Today, we are talking large cap Australian stocks, the banks, miners, and retailers that we know so well. To help us understand how we can best navigate these names, we are joined by Julia Weng. Julia is a portfolio manager on the Paradice Investment Management Australian Equities Fund. The fund has delivered 10.7% a year since inception in 2017, beating the index by more than 1% per year after fees. Importantly, it has beaten it over any time frame. Over the past year, it's outperformed by 2%. Over the past 5 years, it's beaten by 3.3% a year. Consistently beating the index is hard to do. Beating over a short time frame could be luck. Overperforming in certain periods and underperforming in others is a sign you're focused on a certain style or certain part of the market. But beating the market consistently is a sign of a consistent, repeatable process. So that's what I wanted to understand today. What is the process for the team at Paradice? And what can I adopt for my own personal investing process? Now, before we get into it, I want to say a massive thank you to our series sponsor, Viola Private Wealth. Throughout this series, we're hunting down the best fund managers in the game. And guess what? So are they. Viola manages over $2.5 billion by finding the best opportunities across public and private markets. Think of them as the talent scouts for the investment world. Find out more at violaprivatewealth.com.au. It is support from partners like Viola Private Wealth that help us keep all of our content free. Well, Julia, welcome to Equity Mates.
Thank you.
Now, I want to start with a non-investing question to get to know you a little bit. When we were researching for this episode, we saw that your work history was varied, and you actually co-founded a bakery and patisserie, and forgive my pronunciation, Bon Boulanger?
Bon Boulanger.
There we go.
Almost.
Back in 2014. So I guess to kick us off today, to get to know you a little bit better, why starting a bakery? And I guess, fast forwarding to your investing career, how does that experience of founding and running a business inform your investing today?
Yeah, well, I was in my late 20s. I was working at Morgan Stanley as an infrastructure and transport analyst. And I went, okay, what is the most left field thing I could do from here? So I invested my own money and bought 2 bakeries along with a couple of friends in the Northern Beaches. And we made, pastries and sourdough, and I actually just basically restarted the company from scratch. I very quickly learned that running a business is more than, some numbers on a spreadsheet that we as analysts are fanatic about. So, within a month, I basically tore up the business plan that I had. For the first 6 months was just incredible in terms of fighting the number of fires. Yeah, so, for example, we day to day, we meet all these companies and, they tell us about labor challenges, and you don't appreciate it until you're on the ground. For example, in a bakery, I was, processing visa applications for a while because it's really difficult looking for, skilled bakers. And then you think about, investment capex. And it's something you don't appreciate, just running, numbers on a page. But then you go, actually, I need to replace this proofer, this oven, and the maintenance of it is really essential, obviously. And so you really quickly learn about thinking about company as if you're running it rather than numbers on a page. So definitely made me better investor, and hopefully is helping to ask better questions as well.
Yeah. Is the bakery still going today?
It is actually.
Oh, nice.
I think there's 3 outlets. They've changed the name. Yeah. But yeah, it is still going. I ended up selling it to a really great guy who rented the back of the bakery. He was starting out in the markets for weekend markets. Yeah, so
Nice.
really good experience.
Well, let's turn to your investing career, because we're trying to speak to sort of the best of the best in each category. And when we spoke to some financial advisors and some asset consultants, they nominated Paradice and your Australian Equities Fund as a real standout. So we want to understand what your process is, your philosophy, and I guess really try and draw out as much as we can, I guess, to selfishly take it and apply it to our own investing. So let's start at a high level and understand your philosophy. What's the core philosophy that guides you and the team at Paradice?
Yeah, you'll hear about, finding good companies backed by good quality management and that are still, to the market in terms of valuation. That's consistent with what we're looking for, but above and beyond that, we're looking for management teams whose incentives are aligned with how we invest. So we like management teams who are remunerated by, return on capital. Because, as investors, we're putting capital and we want, good returns out of it. In essence, not just chasing growth for growth's sake or empire building. So return on capital is something that we really, really look for, and there are some amazing management teams out there, just to name a couple, A2 Milk, Brambles. I mean, A2, they're going against some phenomenal companies out there like Nestle, with huge balance sheets and huge marketing budgets. But A2, has it's got to be really, really focused on how it spends marketing. Which celebrities endorse, uses to endorse its brand, and it's managed to be a top 5 infant formula brand in China, despite the pretty sluggish, birth rates and the economy that we hear about. So you got to back these management teams. And I think the other one key philosophy is to have a really healthy dose of cynicism.
Okay.
And so, watching out for things like, management spin, because, management tells a great story, but you really need to, dig below the hood. And, we do a lot of work, whether it's like field trips or, expert calls, and really trying to triangulate a lot of information. So we've been fortunate in dodging some of the big blow-ups this year. So that's, avoiding the bad calls, also a big component.
Yeah. We know that a lot of active managers struggle to beat the index. That hasn't been a problem for you guys. You've beaten the index since inception. So I guess taking that philosophy and really applying it at like an execution day-to-day level, how would you define your investment edge? Like what allows you to outperform a lot of your peers?
Look, I think a key one for us is, when facts change, you've got to change your mind. So being really open-minded, because things always surprise you on the upside and on the downside. And so, for example, is Ansell. Ansell seems to be one of these boring, glove and PPE companies. And, went through 2 years, in the COVID period where everyone wanted, any gloves and PPE equipment they could get their hands on, followed by 3 years of indigestion where, you had garages and warehouses filled and nobody wanted a bar of it. I think through that, Ansell's had a few challenges in terms of, pricing discounts and overcapacity globally. However, it's come through the other end, with a much better portfolio of products. It does, for example, gloves for Amazon in warehouses, in the robotics industry, in the semiconductors industry, and increasingly in pharmaceuticals, where it's the number 1 market share across these niche verticals. And now it actually happens to be one of the few companies who can pass on tariffs. Why? We think about the framework for, which companies will ride out the tariff environment well. And you've got to consider a few things. Well, 1, market share. It's the number 1 market share. And so it is taking a price leadership role in that. And 2, compared to its competitors who are mainly out of China, who face much higher tariff impost, it's actually much better positioned. So compared to, we look across the whole market, and it's actually one of the few companies who are able to ride through this tariff environment pretty well and come out better on the other end. It's trading at, 14 times PE, which is actually quite cheap compared to the market on 20 times, growing faster, 15% per year. got good balance sheet, so it's also doing a buyback. And again, the management incentives are aligned with us. They're very focused on return on capital and on organic growth. So it's one of those underrated companies, not in a sexy industry, but actually, we can see significant upside from here.
Yeah, I love that. I mean, good investing doesn't have to be sexy. I think that's a lesson we hear over and over again. When you think about your pocket of the market, Australian equities and particularly some of the larger Australian equities, is there anything that you think is unique to this part of the market that you're looking at? Anything that people who are interested in investing in Aussie equities should know that maybe isn't as applicable if they're looking at the smaller end of the market or overseas markets?
So I guess the banks and the commodities are around 50% of the market, so they do feature quite heavily in the large cap. And as we know, the banks have basically like the Mag 7. I mean, I don't know why ANZ and Westpac rival the Mag 7.
Yeah.
They've seen the biggest re-rate, so increasing multiples with like 1% growth, and they're good companies, and they've done well, and in the Australian economy is pretty resilient. Safe to say that we think there are better upside elsewhere, and so this year has been challenging for the industry in terms of just this, feels like a one-legged stool sometimes. The bank's up and everything else down, and that's being a challenging environment to navigate. Paradice, we've had a really successful track record of investing in commodities. And I know, some managers shy away from that, but we do a build-up of supply-demand model, commodity by commodity. It's not so much a macro view, like do we like China or not? It's more aluminium, what does the supply-demand looks like? And everyone can build a supply model because they can see, what tonnage is coming out of which mines. However, I think the demand side is what people miscalculate. So, for example, even today, we're long iron ore.
I was going to ask about iron ore. Okay, this is interesting. Yeah.
Yeah. So I think, people are worried about Simandou tons coming out in 2027. Out of a 1 billion tons steel market, 100 tons is not going to matter that much. And also, with iron ore grades also declining over time, degrading over time, there's tons that come out of the market as well. And the other thing is, a lot of worries about the China property market. Property used to make up about 40% of steel demand. Now it's about 18%. Because China's managed to diversify its economies away from necessarily property, but more to other fixed infrastructure investments, like telecommunications, transmission, and China dominates in, I think, 40 out of the 60, advanced manufacturing industries these days, like EVs, for example. Yeah. And so, even throughout this tariff environment, we've seen China divert exports away from the US and to other parts of the world, like Africa, Southeast Asia, into Europe. So exports are still up. So I think the worry about steel demand is being probably overly cautious. And so we think iron ore price continues to remain in the 95 to 105 price range. And on those assumptions, your major miners, BHP, Fortescue, remain pretty attractive.
Good news for Australian investors. Also good news for Australia's budget position. So let's hope you're right there. Let's move to sort of your day-to-day decision-making process. And I'd love to unpack how you sort of move from idea to portfolio positions. So maybe if you can choose an example that's in the fund or is in that process and sort of talk us through how you go about coming up with ideas and then validating that and actually entering into the portfolio.
Ideas can come across, in a range of ways. So, when we go to conferences, we meet a lot of companies that we don't own. And throughout, day-to-day conversations with, industry experts, we get a lot of inbound ideas. So, for example, ResMed. We had a small position leading into the GLP meltdown in 2022 and stock fell 30%. So stock ideas can come up as a result of price action as well. And so we're like, okay, stock being down 30% is pretty dramatic. We did probably 30 or 40 calls with sleep doctors around the world to get an understanding of, how does GLP-1s treat sleep apnea? Does it resolve it? And the consistent feedback we kept on getting was, you need to take this drug for life. Once you stop taking the drugs, the weight comes back and actually you lose muscle mass, which is not great for sleep apnea. It's also really expensive. Over the course of doing those 30, 40 calls, we built conviction that price reaction was pretty dramatic and that ResMed was continuing to grow, essentially. And so I guess building conviction is a really important part of the investment process. It doesn't happen overnight. We built the position in ResMed to about 6% of the fund at the time, which was a pretty large position, and we rode the recovery.
ResMed was a fascinating one. It really felt like it divided fund managers from outside of Australia and then fund managers inside of Australia. Like Australia seemed to love ResMed, the rest of the world seemed to not love it.
Yeah, and speak to an interesting point because understanding investor sentiment is also a really important part of the process. Sometimes, it's not just about understanding the company and building up an encyclopedia around it. So, okay, what do investors actually care about? So we took time to try to talk to some US investors about what they thought. It was quite fascinating. The US hedge funds ResMed's a melting ice cube, or shrink as quickly as the hips shrink, It's like, okay, that's fascinating.
Yeah, okay. It is interesting, isn't it? Yeah. It's good to see that ResMed's recovered. And the stat that always stands out to me is that something like 80% of sleep apnea remains undiagnosed. So even if, GLP-1s shrink the market, that percentage undiagnosed is still the huge opportunity in front of these companies.
Absolutely. And you've got AI, you've got, your Samsung and Apple watches, which are, a lot more fancier these days, detecting sleep, helping to actually bring people into the funnel. And, these things like sleep apnea is no longer a stigma. You've got younger women also presenting with it and going, it's okay. I want to get better sleep, so I should get treatment for it.
Yeah. My dad was an early ResMed user when I was growing up, and the machines back then were so clunky and big, and now they're sleek and, the design has come a long way as well. They're a lot easier to use.
Yeah, good to hear.
That's probably not part of your investment thesis, the quality of the design these days. Maybe it is.
You do want it to be easier to use, right? You do want to be easier to use and quiet and portable, reduce the friction of adoption. Because I think, one of the challenges is still, you got to strap this mask to your face every night, and it can be uncomfortable. So you want something that's easy to use. Yeah.
So if we zoom out from ResMed and focus on the process more generally, when you're building that conviction, are there any particular inputs or sources of information that you rely on more heavily? And then on the flip side, are there any that you think are less useful and maybe shouldn't be relied on as much by investors?
I like facts, so things that are...
Yeah, that's good. Yeah, nice.
Some are anecdotal and some are backed by numbers and evidence. Yeah, I think they're all useful at the end of the day. We try to lean into actual, evidence rather than the hype, should I say. So you see a lot of projections out there. And for example, around the build-up of data centers and AI. And while we completely understand, what AI can do, we're, users of AI, we think some of those projections are just, hot air, frankly.
Okay.
And so we want to understand, we want to understand the economics of investments and not just the massive, addressable market and how big and how quickly it could possibly one day grow into by 2050.
Yeah, I think that's an important one for a lot of people because it's very easy to get sucked into those headlines of, consulting firms or investment banks making these giant predictions. And that obviously drives a lot of financial media because it's very clickable, 50 billion to be invested in data centers by next year or whatever. So, yeah, I think that's a good reminder of focus on facts, not forecasts.
Yeah. I mean, there are some industries which are nascent, which are really interesting. MedTech, for example, is one that's, I think, could be one of the, real beneficiaries of AI. And so for these nascent industries, we're happy to kind of imagine the future a little bit. But then, there are some just grand, estimates. For example, around the pace of data center build-outs, because we actually don't have the energy to support that pace. So just being a little bit more measured.
Yeah. Well, speaking of data centers, that's probably a good transition point to talk about the year that was, because 2025 was a wild year. It feels like Liberation Day and tariffs were years ago, but it was just, 6 or 7 months ago. How would you sum up the year that was?
I think you summed up really well. It was like dystopian. It's
dystopian.
Very bizarre. I mean, had you told me, we'd have the highest tariffs in history, I think the average tariffs around 15%, while it is lowered from what could have been on Liberation Day, it is still very, very high compared to the usual, 2 to 3% leading up to it. And then you tell me the US market's at 23 times PE, which is very, very expensive. The market seems very desensitized to any negative news. It feels quite asymmetric in terms of upside, downside. It's been interesting year. I mean, the June quarter in itself, we had the biggest rally, for some time, and all the high beta names ran really aggressively. And then since then, the banks have been choppy. The banks' leadership roles have changed. We saw, CBA being thumped by recent results, and then you got ANZ, Westpac rallying. I think the Aussie market, the nature of it is also changing in terms of what drives the markets. And so with that, we've had to adapt our investment approach as well.
Can you expand on that? Like how is it changing, and then how's that changed your approach?
I think, with the growth of passive investing, such as ETFs, and then you've got, super funds in Australia getting bigger and bigger, and, a lot of them, owning substantial stakes in companies, often up to, 20% for a company. And, at the moment, superannuation companies are, getting inflows. And so what happens is they accumulate stock, but they don't sell stock because of the inflows. So you get liquidity distortions in the market. And so they're pronounced for stocks where there's low levels of institutional ownership. For example, CBA and Wesfarmers, they've got low levels of institutional ownership. So when the stock goes up, there's no sellers, and so the buying activity augments the share price action as well. So it can lead to, more liquidity or flow-driven price action. And, there's a lot more quantitative strategies around as well. And so it can exacerbate the volatility. And that's, that increasing volatility is something that we've observed. And therefore, I think in this environment, the direction of earnings matter a lot.
Okay.
We spend a lot of time working out, whether there's an earnings upgrade or downgrade. Because, for a small upgrade, 2%, the stock could be up 15%.
Yeah.
And similarly, for a small downgrade, stock could be down 10, 15%. It's just exacerbated. And so understanding the direction of earnings is critically important.
Yeah, that's fascinating. So if we turn to 2026, we read a recent fund update, and the fund flagged a moderately cautious view on short-term market prospects and noted exuberance around AI stocks and extended valuations in equities. I guess using that as a sort of jumping off point, how do you view the market here in Australia going into 2026?
Australian economy is in a fairly resilient shape. Got GDP kind of bumbling along around 2%. And, with the, rate cutting cycle, we've had stops and starts. But in general, the consumer is in a fairly decent shape. However, I think the equity market has run pretty hard. And so there is, there's definitely room for caution. We talked about the US markets being quite expensive and, running on AI. And so it's a very concentrated leadership. And, we can have debates about the future of AI. But I think more than that, the market's ignoring the large amounts of fiscal debt, and it's essentially still borrowing from future growth. And I think the listed companies are probably in a better shape than they used to be. I think leverage in the listed companies is very manageable. However, we worry about leverage in the unlisted companies, especially the SMEs who relied on private credit quite aggressively. And so that's almost a dark part of the market that we don't have a lot of insight into. Back in March, I was in US doing some meetings on private credit, and there is a worrying trend of extend and pretend. So, companies are struggling, and, these private credit companies going, oh, that's okay, we don't want you to default, so we'll extend the duration, extend the amount we lend you, and hope that next year you improve.
Yeah, okay. Which might just be kicking the risk can down the road.
Yeah, exactly. So those are not showing up in credit spreads. They're still at an all-time low, which is also quite worrying. So we're not alarmists. We don't call the market necessarily. We're probably a little bit more cautiously positioned than usual. So, running a beta less than 1, to account for potential risks.
Yeah, okay. And so when you are moderately cautious, is it mainly about stock selection, like moving more into those low beta stocks, or is it actually moving more into cash?
The former, so moving to low beta stocks. It's really hard to call the market. So, cash is a fairly small part. At the moment, we're about 2% cash. So recently, we've been dialing down the high beta names, and for the first time in a long time, put some money to work in the REITs, in the domestic REITs, like the likes of, Stockland, GPT, Vicinity, where you've got a, stable macro backdrop, the consumer spending is still pretty strong, and the housing starting to pick up, especially in, beaten up Victoria. And, with a rate cutting cycle on the horizon, that should be helpful for the companies as well.
Are you seeing any common or consensus views that you think are wrong today?
There is a view, I don't know if it's actually consensus or not, that, China is uninvestable because it's structurally challenged. We're a bit more positive on China. I was in China in September, and yes, the consumer spending is still quite weak. The confidence in the job market could be improved. However, I think China is doing a massive pivot from investing in property and, hard investments to increasing consumption. And that's going to take multiple years. You need more confidence in the social security system because the savings rate in China continues to increase. And they're already one of the highest in the world. China is clearly investing in advanced industries. Robotics, China leads robotics. I saw a demonstration of this robot, it was 175 centimeters tall, and it was amazing. I was like, I want to buy this.
What was it doing?
It could fold laundry. It could
Okay.
It could take things off the shelves. It could actually follow your kid around a shop while you go shopping. But
so it's like a household helper robot.
It is.
Okay.
But we also went to see an EV factory that belonged to Xiaomi, and it was one of those dark factories.
Yeah, I've heard about these. These are nuts.
These are phenomenal.
Yeah.
So in this factory, they were making EVs, and literally I saw these vehicles made in 2 minutes. And it was all robotics. The robots were making it. The robots were checking it. The only people there were like the people checking the robots were working.
And for people unfamiliar with the term, they're called dark factories because it's all robots, so you don't need to turn the lights on.
Exactly.
Yeah. Nuts. Yeah.
So I think that's the future of manufacturing, and that's one of the things that we're really excited about. People immediately gravitate to language models and data centers. manufacturing is one of the big beneficiaries of it because, labour is scarce. Manufacturing labour is especially scarce. And so that's where you're going to see the real margin upside from robotics. They're more accurate, they're more reliable. So China leads on that facet. And so I think it will take, a number of years, but we do think there's definitely certain aspects in China that is investable.
Yeah, I was going to say a lot of that is like a longer term, like structural, like China leads all these really important industries going forward. How do you reconcile that longer term thesis playing out with like the short term noise or the short term problem of an escalating and uncertain trade war?
Look, I think trade war is here to stay. It's, I think with the heightened geopolitical relationships and that's changing by the day sometimes, you've got to maintain a view that, these wars can escalate, and even when you have truces on certain deals, for example, rare earths, that they may not hang around either. So I think that volatility is definitely something that, you just got to assume is status quo.
Yeah. Well, I want to move to a couple of stock-specific questions and then we'll get a few final pieces of advice. One position we saw you recently added to the fund was Seek. And, there's questions around sort of lackluster job growth in Australia and, what sort of next with employment and questions around AI, all of that stuff. So I guess just generally, why Seek?
Seek is actually... underperformed the classifieds peers like REA and car sales for the last 10 years. And you go, why is that? Well, it's because, it's been investing quite heavily on its platforms. But what's the commonality here? The commonality is all three of those are very, strong platforms. And, Seek has managed to get increased yields, increased penetration on top of its job ads for the last little while. But what is changing is you're getting good old operating leverage here.
Okay.
So Seek has gone through the last few years what we call unifying its platform between Australia and Asia. So it's done its heavy investment. Now it's about getting the fruit of that labor. So, as we still think, you're going to get double-digit yield and with cost reined in, this year it's guiding towards, NPAT growth in the 35% range. Last week we got really strong job numbers. That's actually good for Seek. And so the Asian business is also being underrated, I think. It's gone through this freemium model and it's come out the other side and we saw double-digit yield growth there in the last results. So, combination of better job prospects data coming out and good double-digit yield growth and then also operating leverage through good cost control.
So that's a company that a lot of people are familiar with. I wanted to also ask about a company that I think far fewer people would be familiar with. Qoria, with a Q, I think formerly Family Zone. Yes. Can you tell us a little bit about this company and why you liked it?
Yeah, so Qoria is a leader in student online safety. So since COVID especially, students have access and do a lot of their learning on computers. So in US public schools, for example, you're given a computer essentially as part of the government funding. But it's challenging to monitor what kids look at. And with, the complexity in AI, social media, it's become imperative, it's become a fiduciary duty for teachers to monitor what students are looking at. And so Qoria is one of the few companies, few global leaders that can do that. So for example, and it's very unfortunate, but you do hear of online bullying, and you want to be able to intervene, but also to prevent. And so Qoria helps with that. So for example, it's got a product that monitors your keystrokes. So if you started typing something that was inappropriate, it can alert, your guardians, the teachers, even, the police if warranted. Now there's increased funding towards this, and two, it's just a necessary part of learning, and three, parents increasingly want it as well to monitor the use of technology at home. And so this is an emerging space, and we think Qoria, there's still a lot of untapped opportunity in penetrating through schools, in homes, in the different products it's rolling out. And it's also that inflection point. It's really important, the inflection point from being unprofitable to profitable and getting some real cash flow in the door as well.
Has it hit that inflection point, or is it close to getting there?
We think it's very close to.
Yeah, okay.
Yeah, so 2026 is the year.
Oh, nice. Okay. We'll be watching. I mean, it's funny. It's like Qoria and Life 360. Australia's like carving out this niche in family safety applications.
Absolutely. So, yeah, Life 360 is also a company that we've, invested in the recent past, and, it's become, this family app, and it's, going to pets and potentially, helping with the elderly as well.
Oh, yeah, okay.
So that was definitely interesting to monitor.
So we've spoken about a couple of companies. Are there any other new or exciting stocks that you're watching or that you've recently added to the fund that you'd be happy to share with us today?
I think I touched on MedTech earlier. I think that space is changing, and something that we really watching for. So in the US especially, there's a lot of crackdown on drug pricing, because US drug prices are something like 10x that of the rest of the world pricing. Obviously very expensive. And to date, most of our healthcare expenditure is spent on treatment rather than diagnosis. So with AI, and not just AI, but just, improving technology, I think the trend could be moving towards more diagnostics. So if you had technology that allowed you to get scans for cheaper, you could detect diseases at an earlier stage, which then, hopefully minimizes the treatment. For example, Artria is a company that is a recent investment of ours. So the code is AYA. So it does scans to do with the heart, and it can detect clots and things like that. Compared to what is out there, which requires, turnaround of 24 hours, Artria can have a turnaround of 10 minutes. Okay. It's also cheaper. There's also reimbursement from the US health system for it. And so that's a, completely untapped space that, could be quite interesting, and, big addressable market, growing quickly. At the moment, it's doing further studies with uni hospitals to try to further the adoption. Other names in that space are worth watching. There's quite a few of these, but, then everyone's looking for the next Pro Medicus.
Yeah, I know. If you find it, let us know. Let's not call it the next Pro Medicus, yes. But you think it's got good technology that has a large addressable market. It's starting to get a foothold in the US, and it's an exciting opportunity.
Yes, absolutely. Yeah.
All right, Julia, we're going to take a quick break to say thank you to Viola Private Wealth. We're spending this whole series talking about who's best at the best. Aussie large caps, small caps, global investing, alternative. But here's the thing. Most investors can't just pick one. That's where Viola Private Wealth comes in. They're like the selectors, building the dream team, taking the best from different markets and asset classes to create something that actually works for your life. Whether you've just sold a business or are looking to diversify away from a traditional property portfolio, they'll help you build a strategy that makes sense for you. Managing significant wealth should not feel overwhelming. With Viola Private Wealth, you will find guidance that is personal, practical, and results-driven. Learn more at violaprivatewealth.com.au. All right, well, I want to move to some final questions, and then we've got like a rapid-fire list to close out. If I was to put you on the spot and I said you could only invest in one theme or structural trend for the next decade, what would it be and why?
I would say, physical automation. So, we talked about a lot of digital automation, but I do think, manufacturing efficiencies, I think that faces an even more transformational advantage. And so, the really boring companies like, for example, Bramble is another one we invested in the last couple of years, and that's doubled. It's pretty boring, makes pallets.
Yeah.
But due to automation, for example, it can now repair pallets in a lot less time. It can, use AI algorithms to detect, to make sure the pallet is uniform. So they go through these automated warehouses and it can actually find lost pallets. That's being an issue for Brambles. You can find pallets and that reduces, CapEx. So, these things sound really simple, but it's actually, very meaningful to these, industrial companies. And so whether that, happens to construction industry, to warehousing. So I'm quite excited by that.
Yeah, I love that. And if you could give your 25-year-old self one piece of investing advice, what would it be?
I would take more risks. I think as a 25-year-old, I think I was fairly fiscally responsible. I saved a lot, but I think cash can be just a drag on building long-term wealth. So I think rather than not knowing or exactly which stocks I should invest in, be prudent, but you got to be in it to win it. So you've got to just invest. And once you invest with your money, you'll follow it, you'll learn. And so I think it's important to read widely and just, get started investing.
Well, Julia, I think that's a great note to close on. I do have these rapid fire questions, but before we go into them, if people want to find out more about you, they can go to paradice.com and they can look at the fund. Is there anywhere else they can go to, to keep in touch or to follow you?
Well, I am on LinkedIn also, but yes, do reach out to the Paradice distribution team.
Nice one. Well, all right. I've got these rapid fire questions, 6 questions. Just give me first thing that comes to your mind. What is one stock or asset class you're excited about?
I think defense industry is actually quite interesting. Every country in the world is spending big on defense for security. And there's a lot of IP that goes with it. So that's a space we've been watching actively.
Does that extend to Drone Shield?
Yeah, they're all quite different actually in terms of the IP. So yeah, a few of those companies are definitely interesting.
Okay, all right. What's one thing you've changed your mind on recently?
We've trimmed our gold and rare earths exposure recently. So gold and rare earths have been great exposures for us, principally through investments in Newmont and Linus. And so look, we still have a positive view, but I think when the gold shot up to 42,200, it's prudent to moderate position sizes.
What's the most underrated investing skill?
It's hard. I think avoiding. So a lot of people associate investing with a lot of action. I think one of the biggest lessons is avoiding hypes and story stocks, and being able to sit back and not lean into it. And also when stocks become really cheap, you're like, oh, it's cheap, now it's time to buy. Being able to walk away actually when stocks, when you go, this is actually structurally broken story and we need to actually just exit rather than doubling down on your losses.
What's one investing myth you would banish?
I think experience is a great thing, but I don't think you need to have white hair to be a good investor.
Love that.
Everyone refers to the most recent crisis as the GFC, but we've had a lot of mini crises since, and COVID is a really big one. But there's no one playbook for how you would invest. So I think it's important to adapt. For example, like in 2021, looking at EV to sales was like, what's that again? But I think, the markets is, one person doesn't drive the market. So you need to be able to adapt, the investment approach as well.
Is there a book, podcast or documentary you'd recommend?
I was reading about small language models the other day, which is apparently a lot more efficient and a lot more task specific than your large language models. And so I'm drilling into that.
All right. And final question, if you can finish this sentence, great investors are, I think, pretty calm overall. So I think you need to have conviction. So what I say to myself is, if the stock's down 20% on not much news, am I happy to buy it? The answer needs to be yes. Before I, take a sizable position, because you need to be armed with facts and evidence. You're trying to exploit emotions in the market, whether it's oversold or overbought. So I think you need to
stay calm.
Yeah, love that. Well, Julia, I think there's been a heap of insight in this conversation. So thank you for joining us today on Equity Mates.
Thank you for having me.
All right, well, that does it for today. Thanks for listening to this episode of our Best of the Best series. This episode was brought to you by Viola Private Wealth. Personal, practical advice for managing serious money. Learn more at violaprivatewealth.com.au.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.